when I look at investments in different time frame, depending on the story for that investments itself, I call it the story. Sometimes people use English more
More
difficult
bombastic
words,
words.
right?
Yeah,
They
yeah,
call it
yeah.
the thesis, right?
Yeah, yeah, yeah.
And the thesis
Story
of
say
your
story
investment
lah,
or whatever,
right?
it is basically it's a story, right? What's your belief? So, for example,
I love how you just did that. Okay, so simple lah, huh? You've done multiple interviews, you have your own show, everything. You don't need me to tell you what to do. Like it's because you're not just throwing jargons at me.
sure.
Right? You're really trying to like provide a frame of thought around it and all that. And I honestly feel it's quite rare lah.
Okay.
Right? Because I don't know if you feel so.
I'm glad to be
Yeah,
here.
yeah.
Because
So
we are still new in the journey, right? And
mm.
for us, we also want to reach out to different target audience.
Mm.
So frankly, a lot of the events that I go to are distributors. So like your
Yeah.
Tiger Food too.
Mm.
And also recently I also do more for like, let's say, insurance agents, OCBCs, panels and things like that. So just a couple of weeks back, I was at Wisma.
Wisma.
Yeah, Wisma third floor, they actually converted. They
I
converted the
didn't
third
know.
floor, third or fourth floor or fifth floor, I can't remember. That place used to be where all the Japanese restaurants were. I don't know whether you remember. There's a food court.
I remember, yes.
Then at one corner, there's actually a lot of Japanese restaurants over there. They changed it into like an OCBC branch. Really? With
OCBC went
bookshops.
into rent for cheap.
No, they got it, and then they wanted to call this integrated banking. So there's retail. They make it in a way it has got food, it has got books, it has got art pieces and what have you lah, right?
Wow.
So that while you're doing your banking outside, there's retail. I think it's a new format
New
lah.
format.
They're trying new format lah.
Format. Not sponsored lah, by the way. Not sponsored. Hopefully we'll get sponsored, but not sponsored. Okay, interesting.
So they are trying new things. So I gave a presentation over there, and these people are generally the older folks lah, I guess, because some of them are your high net worth or your affluent clients, right? Yeah. So at our side, we also want to reach out to the younger generation. We felt that investing is very important, right?
Yeah.
It takes time for you to build your wealth, especially for retirement. And 10 years can make a lot of difference. So it's actually easier if somebody starts off early. In their life. I hope I knew that. Even personally, I didn't really take up personal investing.
What was your
seriously.
backstory? If you can share with our audience.
Okay, so the story is this, right?
A very interesting backstory, yes.
I stumbled in a way into this industry on a bad note. So I came back to Singapore. I remember it's 97, 98, thereabout. I finished my NS because I got a scholarship, which means that I finished my NS obligations later after my studies. And then my first job was actually at MINDEF doing computing.
MINDEF doing programming.
Yeah, I was a programmer. Can you imagine?
So ahead of your time.
So I stayed there for a year. It was actually 1999. And guess what? It was Y2K. So that was a time where everybody was so worried, right? That, after Y2K, a lot of systems will be down and what have you. So I was there, patching up, going at night to different camps to actually patch up the servers. And at the same time, in my daytime, I was doing some programming for them. Coding and what have you. And guess what? When 2000 came, or 99, 2000, the stock market was actually booming. Everybody was so mesmerized by the market, right? Because you can make money, and me included, all of us, we went to the market, we punted. So at a point in time, obviously, we don't know much about, price earnings or, the revenue of the company and so on and so forth. For us, it's just, if there's an IPO, you subscribe for it and you get money, right? Then the other thing is that even during the time, there were all these people with all kinds of ideas. So some would say that, you should be buying the 4 animals.
Why is the 4 animals?
Yeah. So at that time, there were some companies like, they have like Eagle and what have you. So they just randomly put together 4 animals, right? And you buy them without knowing.
And they all die already.
Yeah, what was the real reasons for buying them? So, needless to say, I lost a lot of money during that time, right? In a way, it was a good lesson. It was a wake-up call for me, but it got me really interested in investing. So the funny thing was, I got step by step closer to the financial sector because after a year, the government decided to send me to EDB, Economics Development Board. So I spent the next 7 years or so in a civil service, but doing investment. Inbound investments, getting companies to set up shops in Singapore, It could be a regional headquarters, it could be factories. It was interesting times,
Mm.
and you get this opportunity to talk to the senior management of a lot of companies. Manufacturing, can you imagine the auto companies, the biomedical science companies, like even, the top honchos of, let's say, Olympus, of, let's say, Eisai, Takeda, this whole suite of companies that I've met. And it was really interesting, right? So after, I finished my bond, I decided that it's time to maybe,
Make
really
money.
pursue my passion. And,
Okay,
and
okay.
that's how I stumbled into the financial sector. And I was quite lucky, one of the country manager of CLSA. CLSA is actually a brokerage firm based out of Hong Kong. At that point in time, it was actually a French-owned broker HQ'd in Hong Kong. The Tokyo country head, actually, he served his time in Singapore, so he knew about our system over here, our NS and our, scholarship system. He said, yeah, you're a bright guy, let me give you an opportunity.
You're a bright guy.
So that was how
Yeah.
I stumbled into the industry. I took on coverage of immediately, right? He said, I allow you to cover this group of companies, the non-banks in Japan. And that's how I started in 2006. So after 3 years working there, then I came back to Singapore after the GFC, the financial crisis. And I joined LionGlobal Investors. And that was in 2009 when I really got into the buy side, where instead of just research, here is where we are investing.
Actually
Investors' money,
doing.
actually investing client money, right? So I was the assistant fund manager of a Japan fund then. It's around $1 billion in terms of AUM or assets under management. Not too big, not too small also. We did well for the last 12 years or so. Before 2 years back, I decided that maybe, I should do something more macro. So that was when I took up a different role, as a chief investment strategist for the firm. Yeah, so that's where it is. For my own personal investment, right? I should say the first part, remember Y2K, right? That was the time where I punted. It didn't go too well. I was interested. And along the way, I did invest in stocks, but not having too much of a success until I finally joined the industry, right, in '06 and onwards. And I realized that it is complicated, but it's not as complicated as you think. If you stick to certain rules and you don't get too greedy, and if you do your homework, you do get a fair chance. And I think in recent years, the odds are getting better to a certain extent, because can you imagine in 2000, when I started off, you don't really get a lot of information, right? So today, you fast forward to let's say, in the last how many years, you have all kinds of information out there, right? Podcasts by yourself included.
Of course, we're the number
right?
one. Okay, say
And,
it.
and then you have
You guys have your own show too,
Yes,
right?
yes.
Let's talk trends.
Yeah.
You can check out their podcast.
And you also have all the sell side
Mm.
also coming out with research. They do really good research and content out there. On the internet, you get all kinds of content. The disclosures of the companies are much better. So if you're hardworking, if you spend the time to actually look at the materials out there, the information, and you take the effort to actually educate yourself, you actually could do pretty well investing yourself also. Yeah.
Yeah, that's why you're here to educate us, man. I got you in because we had a coffee shop talk and a mamak, right? Like we're chatting, and then I was like, oh my god, this guy is very interesting. Like and you were sharing with me a lot of stuff in a more approachable, more palatable, a layman type of lingo, right? Which I think is quite rare in the industry, like, because there's a lot of industry talk, right? It's quite common as with any industry, right? So it's not easy for someone to be able to kind of translate it to simple layman terms, right? So I wanted to get you in to focus on what you are focusing on today, right? Which is really like the whole macro type of thing. And because in the broader retail landscape, right, there's a lot of people saying macro not important one, don't need to care, right? Fundamentals, or like just trade, And I probably came from that camp for a period of time. And then slowly, as I develop as an investor, I was like, no, okay, cannot like that. Those things are valid, but the macro environment does affect things, But I don't have a clear frame on like what actually, how do I look about it, right? That's why we are here, right? So what actually is macro? Or can you just debunk the first thing first? Is macro important, right? Should I, as a retail investor, care about it?
Well, it does, right?
That's why you have a job, right?
Yeah. Well, I've worked in both from a bottoms up. So sometimes people say fundamentals, sometimes people say that it's a micro. And then now also for the last 2 to 3 years, I've been working more from the macro point of view, right? So what's the difference? I think as a start, both are equally important and both will give you an edge. So when you say micro, what does it mean? It means, when some people say bottoms up is more important, not important, I think it really depends on the time frame. Right, that some people look at. Maybe let's explain how a fundamental research, as an analyst, how he will look at a stock. So generally, in my last maybe 12 years or 13 years picking stocks, let's say Japanese stocks, it could be Singapore stocks, whatever, right? What we will do typically, maybe to look at the disclosures that the company would have. For example, the quarterly numbers, right? The quarterly results that comes out, have interviews with the management if possible. If not, sometimes it will be the IR of the company.
I also want management, please come on our show. I also want to interview you guys. Yes.
So what we will do is then to take a look, right, at what the companies are telling us. Sometimes, a company might have let's say a medium-term plan, and they will tell you, say, oh, we intend to grow. Let's say, this is our strategy or our plans. We plan to introduce, let's say, product A, B, and C, and this is the potential market, is the potential revenue. Based off that, let's say a fundamental analyst might actually, first question, right? Are these forecasts that the company has given me
Possible.
reasonable,
Yeah,
right?
reasonable.
It could be too optimistic, it may not be, or it may be too conservative. So the surprising thing is that, different management have different styles, right? Some could be more conservative than others, some could be more aggressive. The conservative ones could be because of cultural differences, because he wants to set himself a low target so that he can meet it. or
You want to look good.
he wants to look good.
Yeah.
So based off that, you decide as an analyst, right? So you can calculate based off whatever revenue, your margins that this guy is telling you, what kind of earnings this company should generate over the next few years. Let's say. Or if on a shorter term basis, you can even think about next few quarters, right? Or next couple of years. So it really depends on the time frame that some analysts look at, right? So some funds have different time frames. Some look at things on a shorter term basis, some look at it on a longer term basis, but the method is generally similar. So based off, the analyst then decides that, oh, let's say, 2 years or 1 year or 3 years down the road, this company's, let's say, revenue or earnings is going to be doubled. All things equal, then presumably the price of the stocks could actually double, right? Or at least directionally it should be better. So this is a bottoms up kind of analysis.
Yeah.
Is macro unimportant in this? Answer is no. It's just that the macro portion is already incorporated in the assumptions that you have when you are trying to forecast what the company is doing.
Yes.
Okay. So for example, if a company tells you, let's say, I'm going to launch this new product, a new handphone, let's say, then you say, oh, but the market is saturated, right? And the economy is going into a downturn. And there's too much consumer debt in the system itself. People are actually borrowing too much money to buy all their luxury goods, their TVs, and their discretionary spending is just way out of whack.
Too much bag, too many watch.
With their income, right?
Yeah.
And the economy is actually going to the downturn, meaning that you could actually see job losses, unemployment, and what have you. Then you should actually question, is the assumptions by the management or by other analysts of having this amount of growth or selling this amount of handphones 2 years or 1 year or 3 years down the road, are these assumptions still valid? So this is where the macro assumptions actually comes in. So sometimes when analyst tells you, oh, from the bottoms up perspective, macros are really not important, I think
I always hear that.
It's actually not true, because part of the macro environment or the assumptions are already built into the models that analysts they use to actually to evaluate the companies that they want to buy or they want to sell. So that's first part. But there's the other form of investing is probably, from a top-down basis. So what do you mean by top-down basis? It could be your focus or your expertise is on something different. Maybe as an analyst now, you do not go out and interview specific companies, but maybe your edge is in your readings about events. It could be that, right? So if you think about top-down basis, strategies or funds or products that focuses on different kinds of macro stuff. Let's say, the most recent thing that we can think of, the debt ceiling, the US debt ceiling. The question then is this, right? When is the X date? The X date could be 1st June or it could be 15th of June, depending on when they run out of money. Then the second thing is that would the Republicans and the Democrats actually come to some kind of a compromise, right? And if they come to a compromise, I think the most important thing is what are the conditions of this compromise? Because the conditions could be, a huge spending cut over the next couple of years. What would be the outcome of that? Then the assumptions of economic growth would be much lower, right? Over the next couple of years, right? So this is an event, right? Are we 100% sure that there'll be a compromise? The answer is no, right? Can we try to have an educated guess? We probably can.
We can.
So we can actually take a look at what happened in 2011 during Obama's time, right? We can look at the current negotiations that they are talking about, right? The contents of the negotiations, try to figure out, to come to some kind of compromise, what kind of contents would that be? Then you look at past experiences, right? In 2011, what happened during that time when they had that compromise after X date? Stock market actually crashed. It actually dropped. I think 18 to 20%. The US dollar actually weakened, right? But does that mean that it will happen exactly as that? Answer is no, right? Because there will be other factors that you need to take into consideration. So this is what a macro analyst would do. When there are events, you take that event in totality, you come to a conclusion, an educated guess, and depending on how convicted you are, maybe the conviction level is very high, there will be some kind of compromise and that the content will be pretty benign, then maybe, if that were the case, then you could have a bullish call on, let's say, US stock market, right? And as such, there will be certain stocks that maybe benefit more than others. So that what we call a top-down analysis. And from there, it actually would cause you to actually have a different portfolio altogether. But the time frame now depends on the event itself, because after the event, maybe this is one event, right? So X number of days after the event, you have sold out this portfolio, move on to the next idea, next trading idea. So there are all kinds of ways to make money, to invest in different kinds of strategy. Sometimes people also can take a mixture of a bottoms up and a top down analysis, right? The strength of both sides and marry it together. So there are different ways to do it in different time frames to actually look at a certain issue. So in that perspective, I would say that both are equally relevant in the world of investing.
Yeah, I like it. Although that was a very long way to say that all is important. But I get what you're saying. I get what you're saying. Okay, then in the world of macro, right, there are so many indicators. I mean, okay, not that micro got no indicators. There are certain parameters that we do look at from a bottoms up approach, right? And I think that one is a bit more discussed, and that's not our main focus for today, right? And so in the world of macro indicators, right, there are all these different indicators. Sometimes I feel like they got new indicators every other year or something like that, right? So what are certain indicators that you think are more relevant that you should place your focus on? Because I really don't think all factors are equally weighted. So yeah.
I think when you are looking at, let's say, an environment, a market, and you decide, there's something brewing over there, you want to take so that there could be an investment implication, and as such, you think there's a bet over there. I think the important thing is to remember the indicators that you look at must be relevant to what you are trying to figure out. Maybe I just give an example. We actually do have a newsletter. The newsletter tries to summarize things in a very simple story, so to speak. Last year, we were more bearish. The reasons are fairly simple, right? Let's say, we are bearish on the US market. The story is quite simple, right? You say that, last year, 2022, inflation was high. The US central bank is telling you that I'm going to raise rates. So they started raising rates from March, right? And they also
tell you already, right?
Yeah. So they also have this QT, or they call quantitative tightening, right? That will happen last year, which means that they're going to restrict the amount of liquidity in the system, less money in the system. So that's probably bad news for risk asset, bad news for the market, right? Well, it's a fairly simple call, right? Meaning that when that actually happens, you have less money to go around, interest rate goes up. Generally, when interest rate goes up, the stock market doesn't do very well, right? Fast forward to 2023, we are at the end of the rate hiking cycle. So in May, they raised another 25 basis point. There are some talks, there's some probability that in June, there could be another 25 basis point, or they could just keep it flat for the rest of the year. There's some excess liquidity coming back into the system again because of the banking crisis, or should I say the banking hiccup in March period. So now the question in the market itself is this, right? The US stock market is now fairly resilient. Everybody is expecting that, after such a major rate hike, the whole of last year until this year, 500 basis point or thereabout, right? Surely it will have an impact on the main street. That means on the economy itself. The economy probably will slow down. And if it slows very quickly and drastically, you could actually have a recession.
Yeah.
Some people are expecting that it could be, fourth quarter of this year. Now, in recent times, there are some people who think that it could be, first or second quarter of next year. Okay, so
and we see it, right? We see some anecdotal friends losing job, or like
Correct.
we see some anecdotal elements there
Correct.
already.
Correct.
Yeah.
So there's already some signs that the economy is actually slowing. But at the same time, the market is still very strong. If you think about it, in March, we actually have these banking issues in the US. And
Cannot say crisis. Huh?
you can say, well, it's an issue.
It kind of went through already.
It went through.
Okay.
So what is the impact of that? The impact of that, analysts are believe that the direct impact of that could actually be a tightening of lending standards. So meaning bankers would now be
Stricter.
very stricter when they give out credit, give out loans, especially to small and medium enterprises.
Further
So
slows the economy.
it will slow the economy. It will further slow the economy. So this is the backdrop, right? But anomaly now is that the market is still fairly resilient. Valuations are still very high. So if you look at the US stock market, the valuation is actually on a high side, 18 to 19 times expected PE ratio for this year itself.
What is a fair side? What would be your own indicator? Look at it.
Well, 18 to 19 times is, sometimes you take a range to look at what historically has been trading at. So I will hazard a guess that where rates are today, interest rate are today, is probably more reasonable to be, I guess 13 to 15 times, more than 18 to 19 times, where it's actually at the top end of the range itself.
So how does it relate to interest rate?
Let me answer the question first. So actually, because of all these questions that investors actually have, when you are taking a look at the macro environment and trying to predict where the market is actually going, the indicators that you look at for these circumstances will be slightly different, right? So you will be looking at, let's say, the loan officer survey. There's this thing which generally you don't really look at it closely, right? But in this case, because we are trying to figure out if the credit growth or if the bankers are really tightening aggressively on the lending standards, the loan officer survey becomes really important, right?
Loan officer survey. Okay.
Then it could be things like, let's say, if you think of a recession coming end of this year, one of the indicators that, although is a backward-looking indicator, you might want to look at the employment numbers, right? Because if the unemployment numbers is actually spiking up, it does show that companies are really not doing well and they are actually firing people, right? So at current level in the US, the unemployment rate is still at a fairly low level, although it has actually been rising a little bit, but it's still at a very low level. So the indicators that you actually look at for different market at different time could be slightly different. But the important thing is for you to actually have a story, meaning to have the relevant questions like to answer. For the market to be going higher or lower, there must be certain things, right? There be certain things that you want to answer, certain questions that you want to answer. Like in this case, if it's really going into a recession, then you want to look at indicators that suggest that the market is actually turning or getting worse. So things like unemployment, right? It could be housing, it could be retail sales, it could be their PMI numbers. So there are certain indicators that people will look at. But it's not every time you look at the same indicators, right? So in this case, you'll be looking at some of these indicators. It's fairly complicated at times, but if you simplify it, there are times whereby there are very clear stories.
Yeah. Because not all indicators should be weighted equally. It's not just a macro thing. It's just sometimes where people debate, right? And then there are the main factors at play. Then people take some weird factors on the side and try to substantiate a different narrative. I always find it very funny, right? And I do think this applies to macro stuff also, right? When we think about it.
You are right. So for indicators, there are all kinds of indicators. Some indicators are, you will call it coincidental. It means it reflects the current situation. Some indicators are backward-looking, meaning that, your peers... It happens already, right? Then subsequently, you gather the information, like for example, GDP numbers, right? Sometimes you will say, oh, the GDP in the first quarter of this year is this number. Is it really that important? Right? I will question that, right? I mean, it gives a glimpse of how things were one quarter or a few months ago. So it's a lagging indicators. Some indicators are leading indicators, right? So for example, if it is like claims numbers, it could be something that indicates the employment market sometimes down the road. Or it could be, let's say, what is the orders for, let's say, a factory, right?
Yeah.
If I put in orders, right? So if I put in orders, you see the orders numbers first before the actual production of it comes, it could be a couple of weeks, it could be a few months down the road. So orders are leading indicator of how production will be like, right? A few months down the road. So there are different indicators. Some indicators, are a so-called a leading indicator, some coincidental, some backward looking. So not all indicators are the same. And the same thing, like you have just mentioned, also that they should not be weighted equal, right? So it's not as easy as, let me form, I say, a index of just 10 indicators and then I equal weight it, right? If 5 of them is positive, 2 negative, and
But it's
and 3
becoming quite
neutral.
trendy like that, like this type of.
Yeah, it is.
Yeah.
But actually, intuitively, you know that that's
I
not
know.
that's not the correct.
And that's your professional view of it also lah. It's
Yes.
like you shouldn't think of it this way. Like
Yes,
put
correct.
it into an index and then like this one rate, this one then become a point system. Like
No.
that.
Actually, yeah. So
It's dangerous.
it really depends on the situation itself. So not all indicators are equal, right? Yeah.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka Your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Okay, interesting. Then what about time frame? I think time as an element has been repeated in what you were talking about. And it's also an element that I think a lot of people managing money or doing business or that, you need to realize, there's this thing called time, right? How do you then look at it, or like what indicators with the time element of it, how do I look at it?
Instead of looking at indicators helps you to answer your question.
Okay.
So when I look at investments in different time frame, depending on the story for that investment itself, I call it the story. Sometimes people use English more difficult words, right? They call it the thesis, right?
Yeah.
And the thesis
Story
of your investment
lah,
or
right?
whatever, it is basically the story, right? What's your belief? So, for example,
I love how you just did that. No, because must 包装, right? All must package, thesis, right? Research,
Research,
story
right?
say story.
So let's say a banking stock, because of my licensing, I know I cannot give recommendations or what have you on the show. Just for example's sake, there's a real case, right? There's a bank during the COVID period. The government actually wanted banks to cut down the dividend, so to conserve the capital, right? So you can have bank ABC, so it cuts down the dividend, and then the dividend, maybe it doesn't pay out dividend. So if your story is this, right, you feel that, when COVID ends, there's nothing wrong with this bank, right? There's no reason why the bank cannot pay out the same ratio of its profit as before. So if a bank, whatever profits it has, it pays out 50% as dividend. And as such, if that was your belief, then there's actually a time frame, right? The time frame will be end of COVID, right? So 1 year down the road, if it reinstate the dividend, 50% payout, the earnings are fairly resilient for a bank, even during COVID. And you look at it, if they pay out 50% and based off the current share price that it has, let's say whatever the number is, it works out to be like a 6% dividend yield. And you look at that, it's 0% now because, the government has forced it, or actually it's suggested to it that it cut dividend, right? But it can go back to whatever the dividend it was in the past, and it will be 6%. Would that be attractive, right? So what's the time frame? The time frame will be
End
at a
of COVID.
point whereby COVID is over and when the bank actually reinstate dividend, or when they, in their communication, says we are going to reinstate our dividend. At that point, I guess the market will have priced it in, right? So based off that, then you naturally will have a time frame for your investments. Then you decide at this current share price, if it stays where it is, it will be 6%. But you think about it, a bank generally, maybe in the past, it trades at, let's say, 5% dividend yield or what have you. So the stock appreciation could be something like 18% or what have you, right? Some numbers that you reverse engineer. Then you ask yourself, 18% or whatever percentage that is over a 1 year period, is that attractive for you? Right? So now you have a story, a thesis, is a bottoms up thesis, right? And there's a time frame. What if on the day that it announces and the dividend comes out and you realize the stock doesn't go anywhere?
Yeah. What happens?
Which means that your thesis could be incomplete. There could be other factors at play at a point in time that causes the share price to not reach whatever target or fair value that you believe it to be. So with new information at a point in time, you will relook at your story and adjust and see, what is it that actually causes that? What are the reasons for that? and you relook at your thesis again or your story again. So that's how you should be looking at the time frame, the story, and whatever that the indicators are.
Yeah.
Macro wise, the same thing, right? So just now I brought up the case of, let's say, the debt ceiling.
Yeah.
Right. So the debt ceiling, when would that be? There's a time frame, right?
Yes.
1st or 15th of June, right? But things are fluid. So you might actually have crafted up a thesis, or should I say a story, or a belief, right? And you must have an age in it, right? So you did a lot of work and what have you. You look at it, and maybe your belief is that now at current, the two parties are even more at odds with each other vis-a-vis 2011, right? During Obama's time. So what are the chances of them actually really compromising on good terms? Fairly low. If that were your thesis,
you're wrong.
then then you might think that if compromise doesn't happen on that day, and you actually do have a default, governments don't pay out to social security, doesn't pay out to the doctors, don't pay out to the teachers and what have you, what will happen, right?
Yeah.
I think it will be fairly negative for the stock market. And if that were your thesis, then maybe you would have shorted the market.
Yeah.
And then again, what is the time frame? The time frame will be whichever day that the information comes out, right?
Yeah.
Let's say closer to 1st of June or 15th of June. If it comes to that period of time, new information comes out, then you should revisit your thesis itself. So the time frame that you look at really depends on the story.
The story you're going for.
Yeah. So there are also some investors that are really long term in nature, right? It could be an investors having, let's say, China plus one story. Have you heard of it?
Yeah. China plus.
So this rivalry between the US and China.
I was just about to ask you that question. But yes, please go for it.
So it could be a very long story, right? So investors might ask, if China is no longer a preferred destination for a lot of these MNCs when they are investing to set up their factories and what have you, then where do they set up their factories in? It may not be back home, right? Because let's say if the factory is from, or the company is from, let's say US or Europe, the cost of labor could be very high over there. So they could be looking for the next, let's say, low-cost production region with good labor force. So which is the next area that you should be looking at? It could be India, right? It could be Vietnam.
That's the story, yes.
That's the story, right? So that's the thesis, right?
Yeah.
The thesis is that, a lot of these activities will move to, let's say, China plus one. Plus one means, as a alternative to China.
Yes.
It could be Vietnam. Then if that were the case, then what are the industries or the companies that will benefit if this shift does come? But this shift doesn't come in 1 month, 2 months, 3 months, and it ends there, right? It could be a very long-term structural thing.
Yes.
For the next 5 to 10 years.
Yeah.
So if you have something to that extent, then you might actually, be investing in, let's say, in India or in Vietnam equities. Then the time frame will be much longer. It could be a 2 years, a 3 years time frame. But sure enough, even if you have a long-term time frame for whatever thesis that you actually have, you must always remember to keep revisiting your thesis itself, meaning that with new information coming in, is what you are believing in still valid? Having a long-term thesis with a longer time frame doesn't mean that you absolve yourself of doing hard work. That you have to keep revisiting your thesis itself every time new information comes in.
Fair. So I want to ask you the longest thesis out there today is the US-China dispute, right?
Yes.
And this is the major thesis out there that is being developed, right? I mean, all the biggest guys are talking about, whether it's Josh Yola, whether is it, Bidahari, almost everyone is talking about it. I believe the financial market also cares a lot about it, right? So what is your view on this thing, right? Like US, China, is USD going to end? China going to open up? Blah, 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 all those things, yeah.
I think there are a lot of implications for this story itself, because it's actually quite a complicated story.
That's why I asked you.
It makes it interesting, right?
Yes.
Because there are a lot of investment implications for it.
Yes, a lot.
I think there's this topical thing, a lot of investors, or you see even in the papers and what have you, people writing about de-dollarization, right? In simple terms, it means that the dollar gets replaced by, let's say, another currency or a basket of currencies. But I just want to say that this is going to be a very long-term story. The implications of that is that maybe, it really is not a very major driver for, let's say, USD weaknesses. Why people get so excited about this de-dollarization thesis or story is because the so-called Ukraine-Russia war, Russian reserves were actually frozen.
Yeah.
So one natural question that comes to mind is this, right? You weaponize
Weaponize your
your
currency.
currency
Yeah.
itself. There are a lot of countries who start thinking we could be friendly to, let's say, the Western powers, to US,
many
to the
are.
European
Yeah.
companies. But if one day I fall on the wrong side, we are no longer friends or what have you, would then, would I then lose the use of my reserves itself? Then that would be a big problem for us, right? So if that were the case, then wouldn't I want to maybe, instead of having too much dollars, diversify and use other currencies and also store other currencies? It's a valid question, but I think at this moment, there's no one currency that can actually replace the US dollar. That's one thing. But on the side, you could actually see an increasing use of other currencies in place of the US dollar. So case in point could be, let's say, the recent news about, I think the Chinese government had a meeting with the Saudis. There was this news, I'm not sure whether, it was reported, but there was this belief that some of these oil contracts, the
Petrol
purchase of,
yuan, right? You
yes.
start to hear this
So
word.
this crude oil purchases were actually priced of the
In renminbi, yes.
You could actually see that happening, right? Especially for countries that may not be so friendly to the United States. So
Iran, Russia,
it could
so
be,
they're all,
it
it's
could
like
be,
forming a pack at this
it could
point
be
in time.
a group of other countries, right?
Yeah.
Because it's very difficult for them to immediately replace,
Yes,
right, the
yes.
USD with, let's say, a basket of currencies or just with a single currency. So you should actually see less use of US dollar slowly over time, but it's not a direct replacement of that. So I would say it's fragmentation instead of dollarization. It's a fragmentation. That means it's not only with renminbi, right? Certain countries may actually demand now that
Latin America trying to do their own.
Yeah,
yes,
you could actually ask, if you are a major purchaser or something, right? You may now ask, instead of using US dollar in their own currency, it could be the Brazilian real, it could be whatever. So if Chile actually exports a lot of copper and what have you, or commodities, then they might price it off a currency that they pick, that they choose. This is what market participants are talking about.
So wait, I want to double down on something you were saying. Like it's a slow burn.
Yes, it's a
Right?
slow burn.
Are you saying that because this de-dollarization thing or this reduction in the US dollar dominance is a slow burn, so on some level you can actually write off this impact on your portfolio because there are many other factors within the short and medium term that are way more important than this slow burn?
I think this slow burn or this secular trend is something that you have at the back of your mind. But in the immediate term, are there cyclical reasons or are there actually short-term factors that will drive US dollar more than others? It could be, right? So in this case, I mean, the most immediate one would be, again, I go back to
The
the debt ceiling, right? So if you have a default, there's no compromise, no, I don't care, and we're not going to pay out to the teachers and what have you, we're going to default on our debt or coupons for our treasuries, then the US dollar might actually weaken very drastically, right?
Crazy.
So this becomes the cyclical reasons, right? That could actually have a bigger impact on, let's say, the US dollar or whatever asset class that you are looking at. So there's a slow burn, acute reasons for something to actually happen. The other one could actually be decisions by the FOMC to raise rates or actually to pause or even to cut. If the FOMC continues to raise rates in June, and if they say, I'm going to raise rates by another 25 basis point, and they sort of come out and say, and we're going to raise rates maybe a couple more times, then the USD might actually, strengthen on this news itself, because, with high interest rate means that it's drawing more. The US dollar, it's more attractive to actually invest in the US, right? So there'll be more funds
That's why
flow
there
into
was so
the US.
much outflow from the yen, and there was it was a crisis moment.
So the decisions of the FOMC, if they say something like, I'm going to cut rates, then that could actually lead to a weaker dollar, right? So there are factors that are more immediate, that have a bigger impact on, let's say, USD. Well, but if there's no acute factors, then we go back to the long slow burn, right? There's the slow burn then takes over as the predominant factor. You have to really look at the things, time frame, and also the importance within the time frame that you're looking at.
Yeah, I love it. I love how you set out that it's a frame of the mind, right? Like how do you think about these factors? Like you add a time to them, you add the kind of impact. You look at them from you essentially contextualize it within your story. Right, essentially, right, and not just go on news cycles, because news people they always make everything sound like, oh yeah, it's gonna happen, right? So So there's that part.
Actually, for long-term stories, secular stories, there are many less secular stories out there, right? It could be things like, just now you mentioned US-China rivalry. It could be things like demographics. Certain countries are aging.
Aging.
So when it's aging, what are the stories out there? Certain sectors may benefit. Healthcare could be one of them, or maybe automation could be another one of them, right? So that secular story could actually drive investment. There'll be investment implications. That could be new theses being formed, and you can invest in those. I believe in. I think it's going to be a major boost to productivity in the long future. It's going to change the way we live, and it's going to displace certain jobs, unfortunately, but new jobs will be created, right? We haven't really seen many business models or killer business models that are built around it at this moment. But sure enough, I think we all would agree that this technology is actually very important.
It is.
It has a very long-term implications.
Yeah.
More so than whatever, metaverse that people are talking about. This is really something that's transformational.
Yeah.
So as such, it has got a long gestation period, right?
Yeah.
The investment implications could be additional server farms that are required, more computational power. That's why certain chip companies are rallying, right?
Certain chip companies
could be
you know lah, huh?
Certain business models could actually be more attractive, like maybe cloud, right? So actually, there are many, should I say, secular stories, long-term stories out there, interesting stories. So is this a macro? Again, we come back to this, right? Is this a macro call? Is this a micro call? I think it's both, right? So like I mentioned just now,
fair.
Right? So if you believe in ChatGPT, a macro guy would say, let's say I've seen a recent report. Actually, a number of reports have come out, right? So there are some reports that say, this ChatGPT or this AI thing could actually improve productivity, and the global GDP could grow by 7% over a number of years, right? They are deliberately being slightly, vague about it because there's no way for you to measure it, right? So there are some reports that's come out and say, culturally, certain countries, they adopt new technology faster than other countries. Like, case in point, US, right? When they see a new technology, immediately, the people, entrepreneurs will actually jump into action. They'll try to see if there's ways that they can actually incorporate that into their business models and so on and so forth. There's this cultural bias or this country bias. Maybe some countries do not have the infrastructure to actually to benefit from it. So the impact on different countries could be different. There could actually be a different thesis coming out from it that, maybe on a longer run basis, certain countries, equities from certain countries could actually benefit more than others. But from a micro basis, you might now decide that, based off this new application, this new tool that we have out there, how many more server farms are required? And for the server farms or what have you need a higher voltage, let's say a power component. No? Right? So certain companies, Taiwanese companies that make certain power components may benefit from this.
Very vague.
What is the revenue growth? What is the margins? Because this higher value, right? Higher powered the components are, of course, more expensive than the lower powered ones. So you can work out the revenues, what is the growth trajectory.
But there's also the natural margin depreciation of technology, right?
But you see, for very long-term stories, sometimes, it's difficult for us to see beyond a certain number of years. So as a reasonable test, you do a reasonable forecast out, let's say 3 years down the road. And you use that as a basis to figure out, 3 years down the road at this valuation, is this thing something that is attractive to me, right? So your thesis could be based off that. So longer term trends are important, and there's implications for top-down investing and also from bottoms-up investing, depending, right, on the thesis or the story that you're looking at.
Nice. I like how you tied the whole thing back, right? so that is good. That is good. One last question for you about this whole thing, like chasing hype, right? Essentially, because you brought up the whole AI thing, right? And you've been investing way longer. I have a little bit of a few years, right? So there are all sorts of hype lah. Back then there was a cannabis hype lah, right? Then there was a EV hype lah, right? There's a solar panel hype lah. And then every time when there's a hype, of course the media will push it because that is their incentive. They want eyeballs.
Yep.
Right? And then there will be funds flowing, somehow that thing happens, whether is it retail, whether is it whatever, that's a different discussion, but funds flow. And then you start to see like what I will call hype funds come out, right? Like, so they will essentially, fund houses will push out ETFs that are along this theme. And by the time they come into the space, right, the underlying stocks have all been pushed up. And then they come in, they buy at a relatively high valuation, and then they sell you the ETF when the hype is like there. Probability of it continuing, right, that is quite questionable. So I want to hear your thoughts around around these kind of things? Like, should you chase a hype ETF because there will always be these kind of things popping out? Different fund houses try to be ahead, they will push it out. Or should you just kind of let it taper off and then you enjoy the kind of longer term tail end trends of it?
Okay, so this is a very, very pertinent, very good question. I would not be too judgmental about it. I think there are all kinds of investors out there.
Yeah.
Okay. When there's a particular team, let's say, it could be AI, it could be, EV, it could be, whatever the theme could be. Fund houses or maybe, some banks or have you, they might assemble a portfolio of stocks to say, these are the stocks that actually will benefit from whatever the theme is. Is this the tail end of it? Or does it always launch at the top? Answer is no, right? Sometimes there's still rooms for it to actually to power on, right? Where your homework comes in, and also you must have a thesis, right? So if your thesis is that, at current, I think this hype or this story or this excitement about this story or this trend is going to continue. At current, maybe, on a price to earnings basis, it might be no earnings, right? Like at one stage, the SaaS company, software as a service, right? Companies, there's not much earnings, so people use price to sales. Are they mad to use price to sales? Answer is no, right? Because at a point in time, I think there's a reasonable argument for why you want to use price to sales. So you have to do your own homework. Is this valuation matrix that you are looking at, this story, is it reasonable? So if it's reasonable, it's something that you feel that there's still more potential for, then maybe it is a valid investment thesis, right? For that time frame that you are. But you must always remember that what you are doing, if you are chasing momentum, the momentum can turn very quickly. So you have to be very nimble. You have to be constantly relooking your thesis itself and be updated with the latest information. So it really depends on the style of the individual or the investors itself. If you're long-term investors with a daytime job where you're so busy, you look at the market only in the evening, sometimes you forget, you look at it once a week, then I suggest that you do not have an investment thesis that requires you to look at it right every hour of the day or whatever, right?
Fair.
Because by the time you knew,
it's like,
it's too late, right?
Then you fall asleep the whole day, tired, fall asleep.
Then it could be too late. So I would say that sometimes thematic funds or thematic ETFs, they could have some more rooms to rise. It is up to the individual to actually decide. But if you are longer term investors, then you should look at certain indicators to give yourself a certain reasonable test, right? So things like the valuations, right? Are the valuations actually reasonable? Are they pricing in too much growth in the future? If they are pricing in something that's ridiculous amount of growth,
price
then,
to perfection, right, or something.
then is it now is this now really a reasonable thesis for you to invest in? So I always believe in this, right? For investment itself, sometimes there's this fear of missing out, right? Some listeners or some friends or sometimes they might ask, hey,
especially when they know you do this, right?
Yeah. So
hey, what do you think of this?
What do you think? Then you give them the analysis and what have you, and they decide that this is too risky for me, or I don't have the capacity to chase this because I don't have the time or what have you. Then they don't invest in it, and the share price continues to rise, and then they have this regret, right? They say,
that day I talked to you like that. Yeah. I know.
So I think important thing for investors to remember, and it happens to everybody, is actually to know your circumstances, what is actually relevant to you, and don't be forced into making an investment because of FOMO. If you don't earn from a particular investment, it's of no relevance to you, right? But what's important is that you increase the odds that you benefit or that you win in whatever bets that you put at, and you minimize the losses, because some of your bets are going to turn out bad, right? So you generally should actually try to have less. You should have less losses than whatever gains that you actually have. So by being cautious, do your homework, don't chase. If you don't have the ability to, then you increase your odds of a more fruitful investment.
Yeah. Thank you for your time.
No problem with that.
Love it. Okay, I have 3 questions that I ask everybody at the end. Number 1 is, what has been your best and worst investment you've ever made?
My best investment, silver.
Silver.
Yes.
So you got the silver rally.
I got a huge silver rally. Again, it's a macro thesis, right?
Yes.
The gold price went to its previous peak. Silver doesn't, and it was actually at the doldrums. This is nothing to do with my firm, right? It's just my own personal thinking was that silver is partially precious metal like gold.
Mm.
If gold rallies, means that the precious metal part is interesting, right? But half of silver is industrial and it's being used in solar panels. If the idea of this environmentally friendly thing goes on, people uses more solar in my view, the use of silver goes up, right?
Mm.
So at one stage when silver was too far away from the gold price, I actually bought in silver, and well, that turned out to be a good investment.
Nice. Yeah. Okay. What is the worst then?
Oh, the tech stocks during the Y2K boom. Yeah, so
Yeah.
I lost a lot of money. It was because of lack of homework. I don't blame anybody. It's just that, right? And so as such, I bought into some fairly bad stocks.
It's okay. You came out the other end, right? I mean, yeah. To be fair, that period was quite bad for a lot of families, not just lose money only.
When you are young and you are learning, there's a we say 学费, right? Sometimes you make mistakes.
Yeah. But 你的学费不要太高啦,
Yeah,
right? You
in
control a little bit lah.
yeah.
Yes,
So
yes,
in
yes,
the
yes.
early stage, try to control the amount of bets that you put in, right? That you learn along the way, build up your knowledge. I guess over time, your hitting bets becomes better, right?
Yes, yes. Okay. Next question. What is one thing under $100 that you spend that has been a game changer?
Those watches that,
The Fitbit type of thing, is
yeah,
it? But
because I was actually 10 plus years ago, I was quite obese. I got that, and then it measures my heart rate, and at the same time, it clocks the number of steps or a distance that I run. And with that, actually, it helped me improve my health, right? So
Nice.
I ended up running quite a number of half marathons.
Nice.
Yeah.
Last one. One place you learn that you think is underrated.
I do write a newsletter. If you go to Google LionGlobal Investors, then you probably will find us. We try to make investment, demystify investment, right? We try to write on the market itself. On a quarterly basis, we have our own outlook. On a monthly basis, we try to do a look back, meaning to tell you, let's say people are very busy, right? So on a monthly basis, they look at it and they know, oh, these are the pertinent issues that happen. That's why the market was this way, right? Last month or for the last year to date or whatever the number was, right? And these are the things that investors are looking out for. So on a monthly basis, we try to put out a newsletter, maybe to, I wouldn't say educate, but I'll say, to inform investors, right? Who could potentially be our clients. So we have put in a lot of effort. Yeah.
I know you put a lot of effort.
Yes, into this thing.
Yes.
So do take a look at it. I hope it will be of value to the listeners.
Nice. Lion Global
Investors.
Investors. Thank you.
Thank you very much, Reggie.
Love it.